Hello guys, this is Paris. Welcome to Budgetholics. In our last video, we talked about the best dividend stocks to buy now. And in today's video, I'm going to explain what are dividend stocks, what it means to own a dividend stock, and what are the main investing strategies around them. If you're new to investing, especially in dividend stocks, this is the video for you. Even if you're not new to investing, stick around, you might hear a thing or two you didn't know about. If I missed anything important for our beginner friends, let me know down in the comments. When a public company, i.e. a company that is listed in the stock market, makes a profit, it has three options about what to do with those profits. The first option is to reinvest those profits into the company through various procedures such as R&D. The second option is to buy back shares. By buying back shares, a company expresses its belief that the share is underpriced. Hence, it buys back those shares, expecting to sell them at a later date to earn a profit. In doing so, it increases the price of the stock, thus benefiting already existing stockholders. The third option is to distribute those earnings amongst its shareholders. A company decides what percentage of those profits it will distribute, and at the beginning of the year it announces a fixed payment to shareholders for each stock they own. This payment is called a dividend. Let's say that company X has a current stock price of $100 and it decides it will pay shareholders a dividend of $4 per share. This is called a dividend rate and represents the fixed dollar amount each shareholder will receive for every stock they have. Most US dividend yielding companies will split those $4 into 4 quarterly equal payments, meaning they'll pay you $1 every 3 months. There are some companies that distribute their dividends annually, semi-annually, or even monthly, but quarterly payments are the most common. The dividend yield has become the most talked about financial ratio when it comes to dividend stocks. In the case of company X, 4 over 100 equals 0.04, meaning that company X has a current dividend yield of 4%. This is why it's also referred to as a forward dividend yield. This number indicates that company X will pay you 4% of the money you have invested in the company, assuming that the share price remains at $100 per share. When a company's price goes up or down, the dividend rate stays the same. It's the dividend yield that changes. For example, if company X's share price went from $100 to $50 per share, its dividend rate would stay the same, meaning you would still get paid $4 for each share you owned. However, the dividend yield would double. Similarly, if a company's price went from $100 to $200 per share, you would still get paid $4 per share, but the dividend yield would fall to 2%. That doesn't mean that anything has changed in terms of company dividend policy. It just means that the price went up or down. Companies may readjust their dividend rate next year, but it usually stays the same for 12 months. Keep in mind that companies are not required by law to pay dividends to shareholders, and they can cancel their existing dividends at any time. They usually do so in times of financial crisis, such as the 2008 housing bubble or the one we're experiencing today. The advantage of paying dividends to shareholders, calculated in terms of dividend rate rather than dividend yield, is that investors are protected from fluctuations in the share price. Dividend yield has become an especially popular statistic because of fractional share investing. When you're young, in your 20s, and you want to start investing, you usually look at companies that you like. These are the Amazons and the Googles of the world. After you have successfully set up your first trading account and you have your first $100 saved and ready to invest, you open your brokerage app and you see this, or this, or this. You realize that the game is rigged against you and you can only invest in the companies you like if you have thousands or even tens of thousands of dollars saved up and ready to invest. You think of logging off your brokerage account, of how the system has betrayed you, of how everyone in the world is against you. But then you find out this. You can choose to buy fractions of a stock. This means that you don't buy an entire stock, but just a small percentage of that stock, which you can do in two ways. Let's take the example of Tesla stock, which is at around $600. You can either choose to buy 10% of a stock, which is zero point 0.1 shares, and this will cost you around $60. Or you can choose to buy $20 worth of Tesla stock, meaning that at the current price you'll end up with 0.03 shares of Tesla. In my view, fractional investing is a breakthrough, especially for young aspiring traders who want to invest in their favorite companies but cannot yet afford to do so while simultaneously maintaining a diversified portfolio. Via fractional investing, you can invest in any company with as little as $1. When it comes to investing in individual stocks, you can either be a passive or an active investor. A passive investor usually buys a stock and sits on it for the long term, whereas an active investor makes trades every day, every week, every month, or every year. A common misconception when it comes to dividend investing is that dividend investors are passive, i.e. they buy the stock and they just sit on it. This is not at all true. And the most exemplary counter-argument is Warren Buffett. Buffett has a number of dividend-paying stocks, such as Apple, Coca-Cola, but he is by no means a passive investor. He actively monitors the price of his holdings and increases or lowers his positions based on whether he perceives those stocks are undervalued, overvalued, or fairly priced. Berkshire Hathaway, Buffett's company, owns 52 stocks, 36 of which are currently paying dividends. Berkshire Hathaway does not currently pay any dividends, so if you're looking for a dividend-paying stock, this is not the one for you. However, they do reward shareholders by doing frequent share buybacks. Berkshire Hathaway uses those dividends to further their positions and open new positions in new stocks. Another misconception is that dividend investors lose out on great deals. This is not at all true. There is nothing preventing dividend investors from investing in stocks they believe in, even if those stocks are not currently paying any dividends. Dividend investing is usually a long-term strategy. You'll need to find a methodology that will allow you to place the correct stocks in your portfolio. The easiest way to do this is by logging into your brokerage account and adding those stocks to your watch list. Stocks that pay upwards of 1% are usually a good starting point. The first step is to make your own analysis of stocks on this list and shorten it. Afterwards, you can look online or consult with a financial advisor and maybe add some companies to the list. Afterwards, you can rank those stocks and identify the price at which you're willing to buy. You can also invest in dividend stocks through mutual funds or ETFs. Mutual funds are an investment program that is funded by shareholders and trades on diversified holdings managed by a professional. ETFs, or exchange-traded funds, are a type of an investment fund that is actively trading in the stock market. The main difference between a mutual fund and an ETF is that the mutual fund's price is fixed and decided at the end of each trading day, whereas an ETF works a lot more like a stock, as its price may fluctuate during the trading day. If you don't want to, or if you can't allocate the time to do your own research, maybe investing in an ETF or a mutual fund is the best option for you. Lastly, when it comes to dividend investing, there are various strategies. The first strategy is investing in a high-yield stock. This is the easiest strategy to execute, and you only need to find companies with high current dividend yields. AT&T is an example of a good high-yield company. However, this is the trap that most dividend investors fall into. A high yield is a trap for many new dividend investors. They focus on the alluring 7, 10, 15, sometimes 20% yield, and they pay no attention at the actual fundamentals of the company, at how safe the dividend is, at how quickly the dividend is growing, at how the company's balance sheet looks like, just like a horse focusing on the yield. Another strategy is the dividend capture strategy. In traditional stock trading, brokers usually try to buy low and then sell high. In the case of dividend capture, they buy the company before the ex-dividend date, meaning the declared date before which you need to own a company in order to receive a dividend later, and they sell it after the ex-dividend rate. In this way, they profit from the dividend they receive while holding the company. This is mainly a strategy for active investors. The third strategy is investing in high growth companies that do not pay any dividends. Many dividend investors' goal is to build a portfolio that pays a healthy 4% rate and then retire early and live off their dividend payments. A way to achieve this is by investing early into high growth companies. So the Teslas, the Amazons, the Apples of the world. After 20 or 30 years, you sell the companies and you buy dividend yielding stocks or ETFs. Lastly, and what I'm currently focusing is picking up stocks that grow their dividends at a decent rate. This means that I look for companies that are consistently increasing their dividend payments regardless of their current yield. It goes without saying that if a company has a lower current yield, I expect to see a higher dividend growth rate, and if a company has a higher dividend yield, I am okay with a lower annual growth rate. Each and every one of those strategies has pros and cons, and as with any investing strategy, you do not need to stick to any of those. For example, I am currently buying companies that are growing their dividends. However, I'm also buying good growth and good value stocks. If you want to buy an ETF, there are different ETFs that will match your investor profile. If you want to buy an if you're looking for an ETF that has a high yield, you can look into VYM. Or if you're looking for an ETF that focuses on companies that are increasing their dividends, you can look into VDIGX. Lastly, another powerful strategy when it comes to dividend investing is DRIP, or the Dividend Reinvestment Plan. This means that every dividend you receive, you immediately reinvest it into the company, or you can invest it into another company. The advantage of DRIP is that it affords you more shares of companies at no extra cost to you. And here is where the power of compounding interest kicks in. If you're paid a dividend and then you immediately reinvest this dividend in a company, the next time you get a dividend payment, you will also get a payment on the amount you reinvested in the company, paving the way to infinite wealth. If you guys enjoyed the video, please hit the like and subscribe buttons. This helps me promote my content and also lets me know that this is the kind of video you like. If you're interested in the 5 best dividend stocks to buy now, check my previous video. I'll leave a link here and somewhere around here. Have a great day, everyone. Happy investing.